Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders Weekly for the week of August 4th, 2024. In this week's episode, it's just myself, Sprocket888, and I am going to take a look at hedging. Hedging is something that you do to kind of offer protection to your portfolio in the case of a move that goes against where the weighting of your portfolio is. It's Warren Buffett who said something along the lines of fear when others are greedy and be greedy when others are fearful. And that's really the premise of when it's time to hedge is there's no more inexpensive time to hedge than when the sun is shining and everybody is buying. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, find us, subscribe, and if you can't find it, let us know and we will get it there. But let's hop to this week's content and hedging. What exactly is a hedge? So a hedge is really something where is a counterweight to a certain bet. So if you think the market is going up, you might hedge that bet by buying some sort of protection in case the market goes down. If you think the market is going down and you place bets or trades that are very negative like that, you might hedge those trades by putting forth a trade that is more on the upside to kind of counterbalance that. And one thing that's very, very important to know is anytime you put a hedge on, you are going to slow down the potential growth that you might have otherwise. And what I mean by that is, if you think the market is going up and you have lots of bullish bets on there, and then you hedge those by placing a trade that will protect you on the downside, that trade is going to pull in the opposite direction of your other trades. So if your main trades work out, that hedge will naturally be losing money. Now, the flip side of that is if you're wrong on your bets of the market going up and you go down, that hedge will help protect you from the losses that are going to come from getting the market direction wrong. Now, hedging is not something I typically do a lot. And the reason I don't do it a lot is because I tend to trade what's called delta neutral. So a lot of the trades that I put on are selling option premium, and you can look up delta neutral trading, but you effectively look at your overall portfolio risk and you trade something that is opposite of that. And so a true delta neutral portfolio actually doesn't go anywhere. And you might say, well, why the heck do you trade a delta neutral portfolio if it doesn't go anywhere? And it's because the trades that I do are premium selling. So I make money as the premium decays away. So I don't need the market to move to make money. I make money simply as time passes by. However, a lot of times the market can move in a violent and large direction, often from the times of that real calmness. And so it's decent to prepare for a move like that. However, you don't want to try to put on protection when the market is in a turmoil state. So a lot of times the best time to buy insurance, as I'm always equating option contracts and premium to insurance sales, is when the weather is nice, when there's not a crisis at hand. And it's that time in which premiums are the lowest and the cheapest to buy that protection. And there's a couple of things that I want to do in this episode where I can show you some tricks that you can do, some different products you can buy and sell to kind of lower the cost of that protection. Now, it will come with varying capabilities of protection, but I'll just talk you through a few of these examples in this episode. So the part that I'm going to focus on here is basically buying options, buying put options specifically. And it's the buying of the option where I now have the right to basically exercise these options should they move against me. or should they move in my favor? And a put option is what was going to protect me from the downside. And I'm going to pull up some charts here, or at least some profit and loss graphs to show you how some of this stuff pans out. But you can basically buy a pure naked put. That's going to give you the most maximum protection. Basically, there's no limit to how high that can go on the downside. It basically, the lower the underlying goes, the more that option is worth. It's not really premium, so we're not talking about premium selling here. Sometimes, that comes at a cost, though. It's going to cost money to buy that option naked, and that is the premium you're paying to the insurance seller. And if you don't need it, that's money that you will just have lost. And sometimes that's okay. That cost of that is worth it to keep certain capital free, to keep trading as you want to trade. But sometimes you want to lower that risk, right? Lower the cost of that. And I'll show you how we can do that by selling some things against it. And when you do that, you basically are going to take on a different type of risk. And you can also kind of cap that by counterbalancing it, but that's going to limit the amount of protection that you get. And I'll kind of show you one of those. And so it really just kind of goes back to what fits your portfolio. I'm going to show a couple of different configurations out here of protections on the broader S&P. All right. So what I want to look at here is I'm going to just take a broad hedge. Okay, you could target your hedge in a particular, let's say you trade a lot of tech stocks. You might want to counterbalance that with a trade on the NASDAQ, which is an ETF that's going to track more tech stock heavies. In this example, in this episode, I'm going to talk about the SPY because the SPY is a pretty good general purpose market portfolio. So it'll counterbalance a lot of portfolios which kind of have a wide array of things. And so I've got a couple of trades up down here, and we'll bring those up in a minute. But I want to pull up the option chain here. And what I'm talking about here is the reason I'm going to do this with the SPY. You can really do this with any S&P product. And a lot of times I'll get into futures, so options on futures. So this would be the /ES, which is the S&P future, the mini, and there's a micro, the MES, which is going to be about 1/10 the size of the /ES. There's an interesting thing in futures, and which is why I don't want to use it in this example, is futures themselves have expiration. And so a lot of time your buying power consumption is targeted on when that future actually expires. So when we want to go far out past the current quarter that we're in, if you want to also trade in the future of the current quarter that we're in, you're going to have to actually pony up two sets of buying power because they don't share the buying power across futures contracts. So in order to keep it simple, we're going to look at the SPY, which is not a futures item. It is traded on the open market, the non-futures market. So what do I want to mess with here? Okay, right now we've had a period of very low volatility. Everything is calm in the market. Everything is up and to the right. Stocks just keep going up. Tech stocks just, NVIDIA keeps going higher and higher. There doesn't seem to be an end in sight. And everybody is kind of saying, oh my gosh, buy now, buy now. Who knows how much higher it's going to be tomorrow? And so I'm personally starting to get the vibes that, hey, the market is getting pretty greedy out there. And that's when Warren Buffett says, hey, you better be fearful. Now, because volatility is an all-time low, we actually can purchase puts relatively cheaply. Now, because I don't have any idea really of when I think the market will kind of downturn, I'm going to just take a look at the broad timeline and say, I want to go pretty far out. In the US here, it's an election year. There's quite a bit of turbulence around the election, a lot of uncertainty. And so, who knows what could happen from the markets. But what if we just say, hey, I want some kind of insurance to get me through the elections. And so maybe I want to go out to a December expiration. And so that's when I'm going to come up here to the option chain. I'm going to scroll down to a December expiration, which is 157 days out. Now, this has about 17% volatility, and the implied move is about plus or minus 50. Now, volatility is an absolute all-time low, so 17% volatility is pretty stinking low for going out, 160 days into the future. And so I'll kind of come down here, and most of the trades that I put down here are all centered around the 560 strike. How did I pick 560? Well, we're trading at about 564. 565. And I said, let's just make a nice round number. Let's roll back to 560. Probably could have picked 565 because we're actually gaining in after hours right now, but let's just go with the 560. So the first thing, let's pick a 560. Now I have a couple of orders down here, but let's highlight the one where we buy just one SPY at 560 is the strike. It's going to cost me $14.18. So this is 100 shares of SPY. So this is actually going to cost me a little over $1,400. Well, what does that $1,400 get me? Let's take a look at the P&L chart. And what you'll see here is this is the expected move. So if I actually say, hey, what's the expected move here going out to December 21st, the expected move says, hey, from where we are, we might be up into 624 is one standard deviation to the upside, and we might be as low as 523. Now, this is with the volatility of where it's trading at now. Should the market actually start going down, volatility is going to get bigger and pump up, and this range actually could grow, and we could go farther down. So what is this P&L telling me? This is telling me that where we're trading today, this blue line is basically the value at expiration. So right now, if I go all the way out here, it doesn't matter how high the market goes, I'm going to lose $1,418. Now, where I start making money or start going the other way is once I cross that strike, that 560 to the downside. That's 5,600 on the S&P. So if the S&P, let's just say, traces back to a level of maybe 5,200, coming down here, I'm now going to be profiting $2,674 from that, should it fall down there before expiration. And when I say, limitless protection, this is what I'm talking about. So the risk here is defined at this, 1,004. But look, as the market goes down and down and down, the value of this put just goes up and up and up and up and up. So, what if we have this, massive retrace back to the most recent market low, which was around 5,000, 495. So we come back there to 5,000. Here we're looking at about $4,300 in profit that I would pick up. So this is where I'm talking about, maybe to your portfolio, spending this $1,400 is a decent and acceptable expense for this protection. But maybe you don't want to do that. Maybe you want to try to get that a little bit more at a lower cost. Now, one of the things you can do is this is the option that expires out in December. Well, maybe you don't really think that the market's really going to start kind of going down yet. And you're like, I think I got some time. Probably the market, maybe it'll start going down in September, October, really getting closer to the election, a lot of uncertainty. So maybe you want to sell some puts that say, hey, the market's going to stay above current strike before then. And so that's where I might come back to this option chain and I might say, okay, well, let's go out to, July, or sorry, not July. Let's go to August. Let's go 31 days out. So the August monthlies. And I might come down here and I might say, okay, how do I try to pick up about $14.18, selling some premium on the market going up? And so, let's see, I could come down here and we got 564s trading for about, 5. Okay. Well, let's say, I bet we're going to stay above, 562. That's a 40 delta. You got a 60% chance of being above that strike. So let's go ahead and buy 3 of these. So each of these is about 514. And if I go ahead and I buy 3 of these, that is going to collect me enough premium to pay for this other one. Now, this is going to look weird. It looks like it's going down because this is assuming that what happens if the price goes down here? Well, before these options don't expire, the ones we just sold. But if you're like, hey, you're not going to go down there till September, October, you'll notice 3 times 5 is going to give you 15. So you're actually going to collect about $100 on doing both of these. So we're going to buy that really far dated option and we're going to sell 3 of the nearer dated options. Now, the drawback to this is this is going to take up some buying power. This is going to cost you, it's going to reduce your buying power by about almost $18,000 to do that. That's a trade-off. That's $18,000 you're not going to be able to trade on something else. And maybe to you, that is too much, and spending the $1,400 that you might not get back is the better way to go. Or maybe you say, you know what, I don't need to make this completely free, but I do want to kind of cause the dent to go down a little bit, and maybe you only buy one or sell one. So now you've reduced the cost of that trade by $5.14, pushing this now under $1,000. Now, if this goes away and you get to profit all that, there's your protection, and you got to raise this line up $5.18. And so here you can see that we're trading off. Again, if we only buy one of those, our buying power, it's only going to cost us $200 in buying power. So here you get to reduce the overall thing by about, $500, and it's going to cost you $200. So good deal. And, maybe you want to do two of those. What is that? Now that's where you start getting this. Oh, now we're going to consume about $9,000 of buying power. And so you can kind of mess around with this. It's called a calendar spread, where you're basically trading on one time frame, and then you're also selling a similar strike farther out in another time period. All right, so what other option might we have? So the other option we have is what is called a back ratio. And what a back ratio is going to actually do, and this is almost a free play. And this was one that I kind of like the most. And what is happening here is you're basically going to collect $3 from this trade. Actually, sorry, this now spread is going to cost me $3. But no matter how high this goes, you don't lose any money. Okay, you're not going to lose any money as this thing goes up. And then as you drop below 560, you're going to start adding on protection. You're going to start getting more and more protection. Now, your maximum protection is going to be here at about 5,250 on the S&P level. And at that point, you're now going to be able to close out for about $3,300. Now, the downside to this back ratio, because what I've done is I've bought a 560, and then I've gone out in time to wherever I can go that is half the cost of the 560. And I'll pull this up and show you. And then I buy two of those to basically negate the cost that I put forward. But what that does is you can see down here to the downside now, if we breach the second strike, okay, this is the strike that is at, in this example, 526, I'm now going to have to buy the S&P down here. Well, guess what? Okay, I have to buy it below 526, but I'm still going to profit. And you know what? If the market is falling this far, is buying really that bad of a thing? Going back to what I said on the open, be fearful when others are greedy, and be greedy when others are fearful. And so if we're dropping down here, okay, look, I am being fearful by putting this trade on. Wait for it as the market falls. And then now when we're down here, if I get assigned, I'm going ahead and I'm being greedy here, because others are going to be very fearful at this point. Panic is going to be there. Volatility is going to be is going to start really climbing. And maybe this is a good time to buy, because everyone's going to be running. The price is going to be dropping, and I get in at a pretty good price. So I don't know that buying down here is so bad. So I'll tell you what I mean by looking at the option chain. So let's go down to that December expiration, because that's where I want to kind of target my protection. So if I come down here to December expiration, and we're going to stick with that 560, what I'm talking about when looking for half the price is the 560 right here is trading for 14.18. If I buy that, what I want to do is I want to scroll down here on the price, and I want to try to find something where double that is going to make back my money. And so maybe 530, that will more than make up my money. But I come down here, 526. Now 525 doesn't quite make back my money. Let's go ahead and go with 530, and we can actually show you what that's going to do here. I'm going to buy two of those to get my back ratio. Now look what I've done. If the market goes up, I actually make $110. So I'm getting $110 to put this trade on, and it's going to protect me all the way down to, about 5,000 on the S&P. And you know what? If I get a sign down there, is that really that bad of a thing? So before we move to the one last trade, I do want to call out that this back ratio that I have going on here is going to cost me about $6,000 in buying power. So not terrible, but that's $6,000 I can't use somewhere else. And so maybe that is considered a negative to you and you don't want to take this effort. Just be cognizant that that is your buying power. Now, I'm going to take you to another trade that is going to be kind of maybe a hybrid of both of these options that I've shown you so far. And it's basically called a vertical. Now, this is something where you're basically buying one strike and selling another to reduce the cost. And it's going to cap you on your gains, and it's going to cap you on your losses. You get this step function showing up here. And so what I've done here is I've gone with the 560, which is, that's where I want my insurance to kick in. That's where I want my protection to begin. And I've gone down and I've then sold the 550. So it's only a $10 wide spread. And what this has allowed me to do is this is going to cost me $274 a contract. And I went ahead and I bumped this up to 10 contracts. So it's going to cost me about $2,700 in not buying power, in actual cash. So if we stay up here forever, I'm going to be out $2,700. However, it is going to protect me from 5,500 S&P all the way down to zero, and I'm going to return a profit of $7,200. So this is kind of that trade-off that I was kind of talking about between the buying the one, which will give me, infinite downside protection. So if I go back to this vertical, and let's say the market retraces to 530, okay, 5,300 on the S&P. With this vertical, I'm going to go ahead and be able to collect, $7,200 from this trade. So at 530, I would have $7,200 coming back to me from protection. Now let's stick with that 530 and see what would happen on that naked put. The naked put, I would still be out the $1,400 here, but if I come down to that 530 level, I'm only going to be collecting $1,573. So this is a trade-off. You're going to be spending $1,400 to potentially have a protection of up to $1,500 here with this contract. So if we wanted to keep this pretty similar to the previous one, we would go ahead and buy two of these. So now we're about $2,800. And so now you're 530, you're going to get about 3,000. But if you go with the vertical, you're now costing 2,700. But if you drop to 530, you're going to sit at, 7,200. So this is what I'm talking about. You kind of got to mess around a little bit with the different products to see what fits your particular strategy and what do you like. My personal favorite is really this back ratio where I'm going to stick with the same expiration. I'm going to go ahead and I'm going to buy the protection level that I want to buy. Then I'm going to back down the chain to look for something that is half the cost of what I just bought, and I'm going to double the quantity. And that gives you this kind of sliding protection where it's free to have this hedge. And as you come down to it, you're going to start kind of picking up protection, and then your protection is going to fade. But this is where I'm okay with it because this goes into the be greedy when others are fearful and be fearful when others are greedy. So that brings us to the end of this week's episode. Really just kind of wanted to touch on hedging, and I really wanted to touch on it because we have been in a crazy amount of update, seeming like the markets only ever go up, and the bad news seems to be getting less and less, and everyone's like, the Feds are going to cut rates, things are amazing, things are great. So this is the time when lots of the market and lots of the masses start to get greedy. And I feel like Warren Buffett probably has some things correct in his life when it comes to trading and how he does and how he looks at the market. And I really like being a contrarian in this type of environment. And so this is really where I would start to potentially consider putting on some of these zero risk hedges, as I call it. I mean, nothing's ever truly zero risk, but you get into that back ratio where you get that protection that doesn't cost you anything if you're wrong and don't need it, which is awesome because a lot of times the hedges and insurance are going to be a parachute to your profit. And if you do end up using it, it has this kind of grading scale where it gets more and more and more and more and more. And then it gets a little less and less and less, which you might consider less than ideal. But I would say if we are in that place in the market relative to where we are now, that means fear is starting to run rampant through the market. And that's the time that you want to be buying. And so getting assigned those shares on that downside there is not so negative in my opinion. So that is why I really like that type of hedge when I go to hedge. Like I mentioned, a lot of times I don't because I typically try to trade delta neutral, but it's an option out there, and understanding how these mechanics work, how you can piece them together, that is where you're going to get a trade differential from all the other people out there who are just kind of following the talking heads, listening to the mainstream media. So understand what your options are, understand what you have out there so you can build the products and trade the products that match to your style and your situation. Anyway, good luck out there. I hope you enjoyed this episode. And remember, think outside the block.